taxes going to increase? The Sunday papers were full of stories about potential increases in taxes. So this video looks into some of the taxes that may be increased. If you're new to the channel, then please consider subscribing, and it really helps me if you press that like button. So tax increases. What tax increases could they impose on us? Well, the ones that are being talked about are inheritance tax, capital gains tax, changes to pensions, maybe changes to national insurance and to the dividend tax, and maybe even corporation tax. So quite a lot of different taxes. So let's just have a look at each one of those. Let's start by looking at national insurance and the dividend tax. So let's first of all look at national insurance and the dividend tax. When the Chancellor made the announcement to give help to the self-employed, he also said that the differential in tax would be reduced. Now, at the moment, the self-employed pay 9% national insurance and the employed pay 12%. So I'd expect that to be narrowed or eliminated, so the self-employed will not pay 9%, but they'll pay 12%. I'm not sure what we can do about it, but I would expect that to happen. Now, the dividend tax is a sort of mirror of the of national insurance for self-employed. It's not the same because you don't get benefits of national insurance, but it is intended to be a similar sort of tax at a similar sort of rate. And at the moment, it's at 7.5% for basic rate taxpayers. And I've always felt that a 7.5% tax, it sort of wants to be 10%. So maybe you'll also increase that to 10%. I don't know, that's just pure guesswork. It wasn't even talked about in the Sunday papers. But will he increase the higher rates of dividend tax as well as the basic rate? I think that's less likely actually, because at the moment, the higher rates of national insurance are the same for self-employed and higher paid employees. So that's national insurance and the dividend tax, and maybe he will increase that, and maybe he will also increase corporation tax, which is half of it. But for all of those, they're just taxes on our revenue or our income for a year. I'm not sure what we can do about them. We'll just get taxed on them, and we will not enjoy it, but we'll put up with it, I guess. So let's get on to the ones where we can do something, and there are some things that we can mitigate any increases in tax. So first, I want to look at capital gains tax first. At the moment, the main rate of capital gains tax is 20%, 28% if it's on property, but 20% on other assets. Now, just a bit of historical background. 20% is the lowest that I've known ever in my lifetime. So I think even maybe since the beginning of capital gains tax, certainly for an awful long time. So 20% as the capital gains tax, but normally it has been at the highest rates of tax, so 40%, 45%. That's been a more normal rate for the capital gains tax. And maybe it will go towards that, maybe halfway towards it or completely towards it. Don't forget that in the coalition government, that 20% was 28%, so it has been reduced in recent years. So what can you do about it? Well, changes in capital gains tax tend to be made on the day of the budget, so they're effective from the date of the budget, the date the Chancellor stands up in the House of Commons, not the tax year end. So you might want to think, if you've got capital gains that are inherent within assets of yours, and you want to sell those assets in the reasonably near future and crystallise those gains, I would definitely make those gains before he stands up in November rather than after the speech, because you might pay a lot lower tax rate. So that's really all I have to say on capital gains tax. Let's move on to pensions. So pensions are really important part of tax relief. I always think when the Chancellor talks about increasing revenue, I always look to pensions because a huge amount of tax relief is happening in pensions. And if I was Chancellor and I wanted to look for major amounts of money, then I would definitely look at pensions, because that's where the money is. So what are the tax reliefs that we're talking about? Well, there's basic rate tax relief on pensions. I don't think you'd stop that. Then there is higher rate tax relief on pensions. Now, higher rate tax relief on pensions, I don't believe that if they started a system from scratch now, they would give all this pension benefit to higher rate taxpayers. So I always think that's slightly at risk. And then there is the tax-free lump sum that you get out when you retire. And I always feel that you can get a quarter of your pension out tax-free. It's never taxed. So if you've got £1 million, you can get £250,000 that is never taxed. And by definition, they're giving £250,000 of tax-free money. I mean, I know it's your own money, but £250,000 of tax-free money to somebody who is by definition a millionaire. And I just don't think that they would invent a system like that. Therefore, I always feel it's at risk. And I think the way that they would reduce that is maybe saying that it's the maximum of a quarter of your pension, or say £100,000, whatever is the lower, or something like that. So the mitigation for that is, if you're thinking of taking in a tax-free lump sum, take it before the Chancellor stands up. I always think that, because I always think it's at risk, and I've been saying it for 3 or 4 years and haven't been proved right, but I will be proved right eventually, I think. In terms of the higher rate tax relief, it's one of those things. So when you think about higher rate tax relief, you've got to also think about who are the main beneficiaries of that. Well, the main beneficiaries are actually all in the public sector. So it is doctors. Doctors get higher relief on their very, very generous NHS pensions, as do senior teachers, as do MPs, as do ministers of state, and as do the civil servants who create the legislation. So when you think of that group of people, those are the people who are the main people who are going to pay if they reduce or eliminate higher rate tax relief on pensions. So I just wonder if they really will do that. But that is where the money is, so maybe they might have to. So if you're thinking of making pension contributions, you're a higher rate tax relief, a higher rate taxpayer, then I would definitely make them before the Chancellor stands up. Because although, that's where the money is, but does he really want those people, those groups of people, to pay this additional tax? I don't know. But I do know that if you've got a choice about making your pension payments before the Chancellor stands up and after the Chancellor stands up to give his budget statements, I would definitely do it before if I were you. So then I want to talk about inheritance tax. So inheritance tax is a funny old tax because it doesn't actually collect all that much revenue because it's got some huge opt-outs. So if you're a married couple and you're giving money to your direct descendants, then you've got £1 million, for most people, not quite all, but for most people, you've got £1 million that you can give away before the tax kicks in at 40%, which is a lot of money. Secondly, if you give gifts to anybody, but normally to your children, and then you survive for 7 years, then there's no tax to pay. And also with business property, so if you give business property or leave business property to your family, then there's no tax to pay. And the result of those major loopholes, if you like, means that most estates fall under or substantial parts of the estate fall under the thresholds. So what would I do if I wanted to increase tax receipts from an inheritance tax? Well, I'd perhaps reduce that £1 million to £500,000, or maybe have a 20% ban. So I'd take 20% of the second £500,000. I would maybe look at taxing lifetime gifts. So if you gave £100,000 to your family, maybe I'd think of a 20% tax on that. Maybe I'd maybe think about taxing at a lower rate business transfers. Again, maybe I'd do that. So there are a number of different things that they could do if they wanted to increase the tax take on inheritance tax. So what to do about it? Well, if that is what you fear as well, I would think about making any changes. If you're thinking about some inheritance tax planning, then just do it now. Do it before November. There's plenty of time. You can transfer properties around. There's time to do it all. But do it before November, because we know what the rules are now. We don't know what the rules are going to be like even towards the end of the year. So just do things now if that's what you want to do. Always don't let the tax tail wag the dog. You've got to make sure that you do the right thing first, but then do it efficiently and quickly so that you get what you want, because you know what the rules are now. So I've covered the main taxes. I'm not convinced that there's very much we can do with the increased national insurance for the self-employed, or the dividend tax, or corporation tax, all of which they might do, but hopefully not by very much. They might have a good look at capital gains tax and pensions and inheritance tax, because none of those affect the main tax rates. And if you're worried about that, which I am, and you've got things that you want to do sometime in the next few years, I'll get on and do them now, because I would take advantage of the rules as they are now, if that's what you want to do. Thank you for watching or listening. If you'd like to subscribe, you'll be very welcome to the channel. And if you press the like button, it really helps me. Thank you.